Good morning, and thank you for listening to my presentation. My name is Andrej Kandus, and I'm the founder and principal of Sky Gold Consulting Group, a firm that specializes in advanced financial strategies. And what I'm going to talk about today is what I considered to be a Trojan horse in your estate planning efforts. Now, what do I mean by Trojan horse? What are we talking about? We know that any family office focuses on deal flow. But blindly focusing on that can actually cost you 67% of all your family wealth that you've created through your lifetime. Again, what is this Trojan horse? We know, statistically speaking, that 70% of families lose their wealth in the second generation, and up to 90% of families lose their wealth in the third generation. Why is that happening? What are the main causes for that? We know that lack of systems, lack of being organized, such as having a family office, is often the cause of it's difficult to maintain the growth if there's not an organized structure. We know that for reasons of entitlement, the prior generations worried that the next generation will become lazy and entitled, which a lot of times it does happen. Then the next generation really has no clue about the value of money and how to handle it. But these are all things that we can influence. There's one thing that we cannot influence, but maybe can plan for it and offset it with some other strategy, is taxes. The actual Trojan horse, the estate taxes that under the new administration's proposal it can cost you up to 67% of all the family wealth. So we're going to focus on taxes today. What I just said, something we cannot influence. We're at the mercy of the government tax hikes, and we know that the government does need more taxes. Specifically, there's a proposal in place that Joe Biden is supporting that could introduce an effective 67% tax on wealth. It is a tax that would be a combination of capital gains tax on wealth and the actual tax on the wealth tax, the death tax on the remaining assets after the capital gains tax. But effectively, this would tax a $100 million estate with a tax burden of $67.3 million, a much higher tax burden than it is right now. There's two ways to go about it, of course. We can ignore the threat, just saying, okay, well, it might just be this administration and it's going to be better in next. But what we think is better to get prepared and neutralize the issue if there's a way to do it. So focusing on getting prepared, what are the options? What are your typical options to handle this? Of course, there's ways to minimize the taxable basis of the estate. Every respectable estate attorney has a lot of ways to do that, but there's limits to that. Now, the second thing, a very elegant way to handle this, is to use other people's money to pay for estate taxes, which effectively means using a premium finance life insurance policy. Now, how does that work? We all know about life insurance, but most people don't know how it can be funded, how it can be structured in different ways. There has to be a need established for life insurance. What is the need in this case? The need is the expected tax liability for estate preservation. So let's say if we have a $100 million estate, we can plan and we can establish a need under the new administration to say, we may need $67 million to pay for taxes. So the need for life insurers is the $67 million. Now, what we can do, instead of paying the premiums with our own money, we can actually borrow at preferred rates to pay those premiums and effectively reduce the net out-of-pocket expenses. So what's the primary objective? What's the most important thing here? We are realizing a lower interest rate on borrowed funds than we would expect to earn on other investments or assets. So we're creating a spread, a positive arbitrage. Instead of using our own money, we know that we can make more with our own assets, with our own money, but instead use borrowed funds to pay for those premiums. Now, what happens in these policies is when premium is paid, usually in the first couple of years, there's a collateral shortfall, meaning that the value of the policy is less than what has been borrowed from the bank. So what needs to be provided to the bank, to the lender, is the collateral option, which is the policy itself, plus the collateral shortfall, which then closes the gap and the bank is 100% covered. If that option number one is the most efficient one and is going to provide the best policy performance. Now, there are ways to actually use a special rider in the policy where the cash value is going to be higher in the first couple of years, that is going to reduce the need for collateral, but will affect policy performance. The other component that needs to be handled is the interest for the loan. One option is an option where the client pays the actual interest annually, and this is whatever the loan amount is and the interest, of course, that is being calculated. The other way is to actually cap the interest to a certain amount and then accrue the difference in the policy. Now, of course, it's quite logical then if the client pays the actual interest, that there's going to be less burden on the policy and the policy is going to perform better. But in certain cases, it makes sense for planning to use this capped interest option, but it will affect the performance of the policy to a certain extent. Now, let me give you an example of why this makes sense. Just taking a hypothetical example of a male, a 51-year-old male, we're funding a policy where we want to have a death benefit of $12 million. In a self-funded scenario, one would hypothetically have to fund $7 million of premium over 10 years, meaning $700,000 a year for a $7 million total premium. So at the end of the day, we would have a $12 million death benefit based on a $7 million cost. So the factor between the benefit and the cost is 1.71, which is not bad, but the example of going ahead and premium financing it, this would be actually even much better. The same premium has to be paid into the policy, but in this case, the premium is borrowed, and the collateral in this case, in this hypothetical example, would be $400,000. And if we look at the collateral being a letter of credit costing 1.5% a year, that would add to $60,000 of cost in 10 years. And then if the client pays the interest, let's say assuming the interest is $100,000 a year, we are talking about $1 million of interest cost. So in total, the cost to this, in this example, to the client would be $1,060,000 for the same benefit of $12 million. So the factor is much, much better. We're talking about the benefit is 11 times larger than the cost. So it clearly makes a lot of financial sense to finance the policy instead of paying with your own funds. Now, why would you work with us? Why are we the right partner for you? We are a custom shop. We custom design a solution that fits your objectives. we have a variety of funding options. There's not just banks, there's other options. There's quite a few ways to do this depending on the situation and the objectives of the client. We have a wide variety of carrier options, meaning that we can choose whatever, again, makes the most sense. We have decades of experience and understanding of the needs and challenges of family offices. So we do understand what is important to you. We do understand how things work, and we believe that we have found good ways to help you. The bottom line is, what we feel it's just a disaster to let taxes ruin whatever you've been building all your life. It just doesn't make any sense. Dedicate a tiny amount of funds that you have otherwise available to deal flow to secure family legacy. It really is not necessary to lose all this wealth to taxes because you're not prepared. So please, if you think that this is important to you, that you can benefit from at least learning about these options, please visit www.dealflowtrojan.com, and we've prepared an exclusive Family Office Summit package for you, which includes a free report, a case study, and an educational video that comes along with it. You can obviously always call us at 650-308-9399 or email me at Andrej, Andrej, at skygold.zone. Thank you very much for listening. I hope you learned something useful. This is not typically a topic that I would hear at conferences, but I think that it is an area that is extremely important. I think at least educating yourself about these options and then potentially taking action is something that I would really advise you to do. Thank you, and have a nice day.